The Daily Brief Canadian Macro with your host, Steve.
Welcome back, I'm Steve. This is the Daily Brief Canadian Macro for Tuesday, June 16th, 2026. A U.S.-Iran peace deal is expected Friday, and Canadian bond yields are already falling in anticipation. The problem is Canada's other crisis, CUSMA, which doesn't have a peace deal coming yet. Today is a trade and geopolitics episode, and there's a lot moving at once. We've got Alex McFadden on what falling oil prices and the Iran ceasefire mean for Canadian mortgage rates, and why you shouldn't expect relief at the lender level just yet. Ron Butler on Canada's trade strategy and the hard deadline that most Canadians don't know is 2 weeks away. And we wrap things up with the Loonie Hour on Canada's energy drilling surge. Let's get into it. McFadden is wrestling with two forces pulling Canadian mortgage rates in opposite directions, and the question of which one wins. The Iran conflict shut down the Strait of Hormuz, spiked global energy prices, and pushed U.S. headline inflation to 4.2% in May. Canadian CPI hit 2.8% in April, driven almost entirely by energy. Bond investors repriced for higher inflation, and Canadian fixed mortgage rates, which track government bond yields, not the BOC rate, moved up with them. The best 5-year fixed insured rate today is around 4%. That's the energy shock embedded in the bond market. McFadden's argument is that a durable ceasefire unwinds that trade. Oil is now $78 a barrel, down from highs above 100. The 10-year GOC yield has dropped to 3.39%, the lowest since April. The relief is already showing up in bonds. Fixed rates should follow, but with a lag. Banks move their rate sheets more slowly than the bond market moves, so don't expect a phone call from your lender this week. The ceasefire also isn't settled. As recently as June 11th, U.S. strikes in southern Iran were the most serious breakdown of the agreement to date. A deal is expected to be signed in Switzerland on Friday, but the details haven't been published and markets are pricing in an outcome that isn't finalized yet. McFadden's thesis depends on the ceasefire holding, but Ron Butler's argument is that for most Canadian businesses, even a clean ceasefire doesn't solve the bigger problem. We still don't know what the trade environment looks like in 2 weeks. The number that matters is July 1st, 2 weeks from today. That's when CUSMA comes up for its scheduled review. Canada formally notified the U.S. that it wants renewal on June 2nd, the same day the U.S. Trade Representative proposed an additional 10% tariff on Canadian goods, citing forced labor enforcement concerns. CUSMA-compliant goods are exempted, which Prime Minister Mark Carney says covers the vast majority of Canadian trade, but it signals the posture Canada is negotiating against. Greer has repeatedly said tariffs are a new reality Canada will have to live with, and the White House wants significant changes, especially in the automotive content rules and in dairy access. Canada's strategy has been framed as a Fortress North America pitch, positioning Canada as a China risk reduction partner and continental industrial ally. The problem Butler identifies is that the actual terms aren't public. Canadian businesses that need to make capital investment, hiring, and supply chain decisions right now are operating blind. That uncertainty is its own economic cost, and the clock is running. Butler wants clarity on the U.S. relationship, but the Loonie Hour points to one sector that isn't waiting for it. In energy, the investment is already happening. As of the week ending May 29th, Baker Hughes counted 162 active oil and gas rigs across Canada, up 45% year over year, and the highest level since 2014. That 2014 reference matters. It was the last peak before the oil price collapse that hollowed out the sector for years. The industry is not behaving like that history is repeating. The reason is access. Canada Energy Regulator data shows natural gas production hit record levels in 2025, averaging 19 billion cubic feet per day, with LNG Canada now providing an export route to lucrative Asian markets. Producers have somewhere to send the product, so the drilling makes sense. The Loonie Hour's deeper point is about the current account. Energy generates hard U.S. dollar inflows in an environment where the loonie is at 71.5 cents U.S., and Canada is running a goods trade deficit with the U.S. Those flows matter. They support the current account in a way most services don't. The wrinkle is the same one running through the whole episode. The ceasefire that might ease mortgage rates is also pushing oil towards $78 a barrel. Lower revenue for the sector doing the drilling. The rig count reflects decisions made at higher price expectations. If oil settles here or lower, some of that activity stalls. The takeaway for today, Canada is exposed on multiple fronts simultaneously, and the responses are happening at different speeds. The bond market is already pricing in the ceasefire. Yields are falling. Fixed rates should follow as well. But the Friday signing isn't done, and as of June 11th, U.S. strikes in Iran were still happening. The relief is real and fragile at the same time. On trade, the clock is the story. July 1st is 2 weeks away and the terms are still unpublished, and a new tariff threat landed on June 2nd. Businesses can't plan. Capital can't commit. In energy, however, 162 rigs are drilling, the most since 2014, because one sector decided not to wait for clarity. The irony is that the ceasefire making mortgage holders hopeful is the same force pushing oil towards $78 a barrel and pressuring the revenues that make that drilling viable. Well, that's today's episode. Thanks for watching the Daily Brief. All credit goes to the creators featured today for their original analysis and insights. You can find links to their full videos in the description below. If you found this video helpful, please subscribe, hit that notification bell so you don't miss our next brief, and don't hesitate to comment if there's a creator or topic you'd like to see covered here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.